When thinking about the anti-ESG movement and shareholder activism, a lot of people's first inclination is to talk about how many anti-ESG shareholder proposals have been filed and how low the support for those kinds of proposals typically is. But in our view, that's actually not the best impact of the movement's success. Instead, the anti-ESG's impact should be measured by the potential PR nightmare that can arise for companies who are indeed targeted and do not navigate this tricky topic appropriately. Now, the anti-ESG movement's main target for a lot of their campaigns has been large institutional investors and how they have chosen to vote on E&S proposals. Though certainly it's not the only cause in the drop in support over the last 2 years, we're definitely seeing institutional investors making different decisions on environmental and social shareholder proposals. And that, again, is true proof that the anti-ESG campaigns are making an impact on voting decisions. Now, looking ahead and thinking about where this is going, I think the anti-ESG impact is going to continue to pick up momentum going into the 2024 presidential campaign. The Republican Party has seen electoral and fundraising success using this anti-ESG, anti-woke messaging across America, and we expect that to increase in volume as the primary campaign moves forward.
One of the interesting takeaways for us this proxy season is actually how little changed with universal proxy in effect. When you look at the strategies used in proxy fights, press releases, fight decks, and use of the media, very little actually changed in terms of how companies and activists are deploying these tactics. I think the main thing we've actually seen change is how boards prepare for shareholder activism. With universal proxy in effect, there's been a focus on director relevance and showing the value each director adds to a board. We've seen this play out in proxies, in director biographies, and shareholder outreach, where boards are really focusing on showing what value each director brings and how they help protect shareholder value. Last year, market uncertainty and a rise in interest rates led to a slowdown in M&A. Now, as we see green shoots of M&A activity coming back to life, we expect activists to shift their attention towards one of their favorite pastimes. For sellers, this means beware of arbitrage. For buyers, any transaction that has potential antitrust concerns must be carefully calculated before going public. We saw with Illumina and Icon the downside risk that a board faces if its potential merger hits the antitrust buzzsaw.
In the UK, one of the most common activist strategies is to vote against a director's remuneration report. This sends a very strong message about shareholders' dissatisfaction regarding the executive's performance. While these proposals are typically non-binding in nature, they can raise significant media scrutiny, impact the executive's reputation, and raise questions around the board's ability to effectively oversee the business. When reviewing these proposals, shareholders typically look at factors such as share price performance, previous dissent, and very importantly, the ratio of CEO to worker pay, which has come under great scrutiny in recent years in light of the impacts of the COVID-19 pandemic and the cost of living crisis.
I would say yes and no. Over the last 3 to 5 years, we've definitely seen a significant increase in pressure investors are putting on public companies in particular on ESG and how to integrate that into their business model. But most recently in the last 12 months, we've entered a bit of a holding pattern, I think, whereby the worst offenders are probably getting vocally criticised publicly, and those that are taking actions are probably feeling the pressure from a direct engagement with investors. And I think what that brings to the fore is how are you focusing on engaging with your stakeholders and convincing them that your business model is a sustainable one for the future.